The financial world is witnessing a rising tide every day, not with noise, but with cold numbers and quiet decisions from economic powerhouses. In this context, the faith in the US dollar, once considered the last bastion of global financial stability, is being seriously challenged. US Treasury bonds. The faith is retreating. The US Treasury bonds, one of the safest financial instruments in the world for decades, are being turned away by the big players. Wall Street, China and Japan, three of the largest holders, have started to sell off large amounts of these. Citadel Securities, one of the largest financial institutions on Wall Street, recently announced a drastic reduction in its US bond holdings, amounting to billions of dollars. This is more than just a portfolio adjustment, it's a clear statement of loss of confidence in the safety of US government. Bank giants JP Morgan, Bank of America, and Wells Fargo are no exception. They have cut their investments in Treasury bonds by 8% to 11%, respectively. Why? The reason? Yields are no longer attractive, and the fear of a debt crisis is increasingly evident. China and Japan quietly withdraw. It's not just US financial institutions, the countries that own the most Treasury bonds are also quietly withdrawn. China, which held more than $859 billion in 2024, fell to $767 billion in February 2025, its lowest level since 2000. Japan also sold more than $21 billion, bringing its total outstanding bonds down to $1.03 trillion, its lowest level. This is more of a strategic signal than a market reaction. In the eyes of these countries, the risk of a devaluation of the USD and the US government debt is no longer the US response, and the potential consequences in the face of this wave of FLIGHT. The US government is looking to respond by loosening capital ratio regulations for banks holding bonds. This is intended to encourage banks to buy more Treasury bonds without having to hold too much counterpart. However, this approach poses a huge moral hazard. When banks are incentivized to hold an asset that is losing confidence, any shock, such as a debt bubble bursting, will have consequences that ripple through the finance. Meanwhile, the U.S. national debt is expected to reach a record $1.8 trillion in fiscal year 2025, equivalent to 124% of GDP. The cost of debt interest alone has reached more than $1.12 trillion USD, exceeding defense spending. A fact that is shaking financial analysts. Gold, the rising safe haven asset. While U.S. bonds are gradually losing their appeal, gold is shining. The price of gold exceeded $2,380/ounce in April 2025, up more than 6% in just the first few months of the year. Notable. While China, Singapore, Poland, increased their gold reserves to 290 tons in the first quarter of 2025, up 45% compared to the same period last. This proves that countries are shifting their asset reserve strategy, considering gold as a safer haven instead of the U.S. revolution in finance, crypto debt and smart contracts. While the traditional financial system is crumbling, hedge funds like BlackRock and many large trading houses are experimenting with crypto debt and smart contracts, blockchain-based financial solutions that could radically change the way bonds are issued, traded and stored. This is not just a technological innovation, but a shift in reference frames, reducing dependency on the US dollar and traditional financial institutions. Rare earth crisis, China's strategic strike. And then, in the midst of that turmoil, an unpredicted punch from China hit the US technology market, a complete ban on rare earth exports to the United States from April 2020. No press conference. No negotiation. It was a unilateral decision by China's Ministry of Commerce, but the consequences were immediate. A $2.3 billion US satellite launch was delayed, not because of a technical problem, but because of a shortage of neodymium, a tiny but essential mineral used in satellite navigation, rockets, and even smart. China now controls 89% of the world's rare earth refining capacity. The key is not the mines, it's the processing capacity. The US and the West, despite rare resources, cannot replace China in the short term. A final warning: if this trend continues, a weakening dollar, falling treasury bonds, unchecked debt growth, and China's tightening grip on strategic minerals, the US could be headed for an unprecedented financial crisis that will not only shake Wall Street, but also cause a global domino effect, because the world still relies on the US dollar. And while the giants are moving, the question is, are we the little people, ready?